interest income or do you even pay interest income, then you must know the TDS rules applicable on such income. Many of us save our money either in fixed deposits or recurring deposits, and TDS becomes applicable on such interest income. Watch the video till the end to know all about it. If you're not aware, then TDS is a system incorporated by the government to generate tax revenue at the point of origination of such income, which means that the tax is deducted by the payer of the income before such income is paid and then remitted to the government by the payer on the behalf of the paid. Hello and welcome. I'm Jyoti Arora, a tax expert from Clear. As you know, Clear is India's largest tax and financial services platform where we have served more than 6 million plus return filers. Now, the provisions of tax deducted at source presently apply to several payments like salary, interest, commission, brokerage, professional fees, royalty, etc. However, in this video, we are going to discuss the TDS applicable on interest income other than securities under section 194A. The TDS provisions on interest earned from securities specifically is covered by section 193, but we won't cover that in this video. If you want, we can create a separate video for that. So let's begin. But before that, I have an exciting announcement for you. We have a free giveaway for our new subscribers, which is a comprehensive guide for income tax returns for financial year 2021 that will help you with basic doubts you may have about return filing. To claim it, subscribe to our channel and you'll find the link in the description box below. So let's get started. Now this section specifically deals with deduction of TDS on interest other than interest on securities. Now interest on securities means interest income from debentures and bonds, etc. And there is a different provision, that is section 193, which covers TDS on interest from securities, and so it is not covered under this provision. So then what all interests are covered by this TDS provision, that is 194A. Now interest income like interest on fixed deposits, recurring deposits, interest on unsecured loan, etc. will get covered here. Firstly, we will see who is the payer and the payee to whom these TDS provisions will become applicable. Now, the payer can be any person defined in the Act, like an individual, HUF, company, private and public, etc. But there is a condition to this. We will see that in a minute. Now, the payee can only be a resident person. This means that these TDS provisions will not become applicable to non-residents. That's clear, right? Now, coming back to payer, there is one condition, that is, in case of individuals and HUF, these provisions will become applicable only if they have a business with a turnover exceeding rupees 1 crore in the previous year, or in case of profession, the gross receipts are more than rupees 50 lakhs. So, why is this condition added? Now imagine a normal individual, suppose a homemaker or a housewife, paying such interest and who does not have a business or profession. Now it is not possible for them to deduct the TDS and then pay the TDS amount to the government and also file the return after all of this. Now that's not feasible as they don't have the know-how, right? But if any individual or HUF who has a business with a turnover of more than 1 crore or is in profession with more than rupees 50 lakhs of gross receipts, then in such a case, they will be liable to deduct the TDS. First, Akash Enterprise, a partnership firm, took a loan of rupees 10 lakh from a person resident in India. Now, interest on loan for the financial year 2021-22 amounted to rupees 1 lakh. Now, should the firm deduct tax at source from this interest? Now, tax is to be deducted under section 194A if the interest is paid to the resident. In this case, the firm has paid the interest other than the interest on securities to a resident, and hence the firm has to deduct tax under section 194A from the interest income of rupees 1 lakh. Second, now let's see the second illustration. Mr. Rajat is running a garment factory and the total turnover of the factory during the financial year 2021-22 amounts to rupees 1 crore 84 lakhs. Now on 1st April 21, he took a loan from his relative residing in Mumbai, and The interest on the loan for the financial year amounted to rupees 80,000. Should Mr. Rajat deduct tax? Now, as per section 194A, again, individual or HUF has to deduct tax other than interest on securities if his turnover or gross receipts during the preceding financial year exceeds rupees 1 crore. And if it's profession, then the gross receipts are more than 50 lakhs. Now, in this case, the interest pertains to financial year 2021-22, and the turnover of Mr. Rajat for the financial year 21-22 is rupees 1 crore 84 lakhs, which is about rupees 1 crore, and hence he is liable to deduct tax in respect of interest paid by him. Now, the general rule is that the payer has to deduct TDS if the amount of such interest paid or credited is more than rupees 5,000 in a financial year. But is important here. So the general rule is, again repeating, TDS is deducted if the interest paid is more than rupees 5,000. But in case of payer being a bank, cooperative society or post office, the TDS will be deducted only if the interest paid is more than rupees 40,000 in a year. Now, it does not end here. The limit of 40,000 is rupees 50,000 in case the payee, that is the receiver of the income, is a senior citizen, right? So in short, if you are not a senior citizen and earn fixed deposit interest from the bank, then the TDS will get deducted only if the amount is more than 40,000. And if you are a senior citizen, then TDS will get deducted only if the interest amount earned is more than rupees 50,000, not otherwise. Now the question is, what all interest will be covered in this limit? So only fixed deposits and recurring deposits interest are covered under this limit, because the interest on saving bank account is not covered under any TDS deduction rules. Now here I would like to give one clarification that this limit of 40,000 or 50,000 is per bank wise and not branch wise. This means if you have accounts in different branches of the same bank, then the interest earned from all these branches of one bank will be considered in cumulative to calculate this threshold. For instance, if you earn interest from 3 different branches of one bank, say rupees 15,000 from every branch, then as total interest earned is rupees 45,000, this is above the threshold limit, and so the TDS will get deducted from this income. Now, rate of TDS is 10% when the PAN is provided by the payee. Now, this rate was 7.5% for the interest credited from 14th May 2020 till 31st of March 2021 as a COVID relief given by the Finance Ministry. Now, if you are not a senior citizen and earn a fixed deposit interest of rupees 50,000, then TDS at 10% of 50,000, that is rupees 5,000, will be deducted from the interest income and deposited to the government. This rate of 10% will increase to 20% if the payee's PAN is not provided. Also, no surcharge or education cess or higher education cess is levied in these rates, and so the tax will be deducted at source at this basic flat rate of 10% with PAN and 20% if PAN is not furnished. Now, before we proceed, I would like to give a small clarification of TDS. So TDS is just a mode by which tax is paid to the government at source. It does not state its actual taxability or exemption. For instance, if you fall under 30% tax bracket, but the TDS on interest income is deducted at 10%, this doesn't mean that once your TDS is deducted, you don't have to pay any further tax. This means that 10% tax is deducted at source, but when you file your return, your tax liability will be calculated at 30% only, and you can take the TDS credit of this 10%, right? Effectively, you will pay balance 20% of tax before filing of return. Hope this is clear, as a lot of people have this confusion. So, have you understood the TDS rules relating to interest income? If yes, then please type clear in the comment section below. Yes, there are exceptions to this rule of TDS, which means in certain scenarios, no TDS will be deducted from the interest income. Let us see them one by one. First, interest earned on saving bank account as I already mentioned earlier, no matter how much income you earn from the saving bank account, TDS will not be deducted. Second, interest on income tax refund. Now, income tax department is not liable to deduct TDS while making the payment of interest amount on the tax refunds. Third, interest paid by partnership firm to the partner is also not subject to TDS. Fourth, interest paid to any bank, LIC, UTI or any insurance company. Now you must be thinking, who pays interest to these? For instance, LIC or a bank have invested in corporate debentures. So any interest given by such a company to these will not be liable for TDS deduction. Next is interest paid by cooperative society to any member or any other cooperative society. However, there was an amendment to this, which was that if the cooperative society's last year turnover is more than rupees 50 crore, then TDS will be deducted if the interest paid is more than rupees 50,000 to senior citizen and rupees 40,000 in case of others. Now, Form 15G and Form 15H are the forms you can submit to prevent TDS deduction on your income. Form 15H is for senior citizens who are 60 years and above, while Form 15G is for everybody else. Now, some banks allow you to submit these forms online through their internet banking. Form 15G and H are valid for one financial year, so please submit these forms every year at the beginning of the financial year. Now, this will ensure that the bank does not deduct TDS on your interest income for that year. This declaration can be submitted by the payee along with his or her PAN only if some conditions are met, which are as follows. First, recipient is a person other than a company or firm, which means that company or a firm cannot submit this form. Second, tax on the total income of the previous year is nil. This means that the total income does not exceed the exemption limit, which is 2.5, 3 lakh or 5 lakh as applicable. Now, the exemption limit condition is not applicable if the recipient is a resident senior citizen, that is someone who is age 60 years or more. Now, this means that a resident senior citizen can furnish the declaration in Form 15H even if the annual interest likely to be paid to him exceeds the exemption limit of rupees 3 lakh or 5 lakh as the case may be, provided that the tax payable on his total income after considering the rebate under Section 87 is nil. Now, as per the provisions of Section 197, the recipient can apply in form number 13 to the assessing officer to get a certificate authorizing the payer to deduct the tax at a lower rate or do not deduct tax at all. Now, there are few conditions that are required to be met. Also, there is no time limit for application and it can be applied at any time before the actual deduction of tax. If the recipient does not have a PAN, then he cannot apply, which means PAN is mandatory for this certificate, and this certificate shall be issued directly to the person responsible for paying the income on a plain paper under the advice to the applicant. Now, the certificate cannot be issued with retrospective effect, and the recipient have to furnish a copy of such certificate to the person responsible for paying the income for lower deduction of tax. Tax deducted during the month of April to Feb is to be deposited on or before 7th of the next month. Tax deducted in the month of March is to be deposited on or before 30th of April. For example, tax deducted on 25th of April is to be deposited on or before 7th of May, whereas tax deducted on 15th March is to be deposited on or before 30th of April. Now, there is a penalty by the government for delay in deduction or payment of TDS. Now, interest penalty is at 1% for every month or a part of month on the amount of such TDS from the date on which such tax was supposed to be deducted to the date on which the tax is actually deducted. Whereas in case of TDS is deducted but it is not paid to the government, interest penalty is 1.5% from the date of deduction to the date on which such tax is actually paid to the government. So the TDS penalty is higher if you have already deducted the TDS but you have not paid it to the government on time. every deductor has to furnish a TDS certificate to the deductee in form number 16A, which is TDS certificate for payments other than salary. Now this certificate is to be issued on quarterly basis. We will see when these certificates are to be issued. Now what is TDS return? Now every deductor who deducts TDS has to furnish its details to the government on quarterly basis. In other words, deductor has to submit quarterly TDS return in a prescribed form. Let us see what are the due dates to issue TDS certificates and TDS returns. Now, as you can see in the table, issue of TDS certificates is to be made after 45 days from the end of the quarter, like 15th of August, 15th of November, 15th of Feb and 15th of June. Whereas the due date to file TDS return is after 30 days from the end of the quarter, that is 31st July, 31st October, 31st Jan and 31st of May. Now the deductor will be liable to penalty, interest, prosecution, etc. if he makes any of these following defaults. First, default in obtaining TAN number, that is tax deduction account number. Now every person who is liable to deduct TDS must obtain this TAN number, but there are certain exceptions. For example, a person liable to deduct tax under section 194IA, that is TDS on purchase of building or land, and 194IB, that is TDS on payment of rent, then 194M, that is TDS on payment of commission, contractual fees or professional fees by certain individuals or HUF. So these persons are not required to obtain TAN. Except all of these, any other person who is liable to deduct TDS should obtain TAN. Second default could be default in deduction of tax. Third, default in payment of tax, that is TDS has been deducted but it is not paid. Fourth default could be default in filing of the TDS return. And fifth could be default in furnishing the TDS certificate to the payee. Now, apart from the penalties that are available in the Act, in case the payer does not deduct TDS or has deducted but not paid to the government before the ITR filing due date, then such an expense will be disallowed up to an extent of 30% from the business or profession income. However, any payment will be then allowed for deduction in the year in which such TDS has been paid to the government. For instance, if the payment is made in next year instead of current year, then such expenditure will be allowed in next year and disallowed in the current year. Now again, such expenditure will not be disallowed if the recipient of the income has paid the tax on such income while filing the return. In such a case, the payer has to submit Chartered Accountant certificate in form number 26A electronically to the government. That's all for today, folks. Hope this video was helpful to you. If you have any questions, then please ask us in the comment section below. We are always #here to help. Now, just a reminder that the return filing due date is few days away and you must not wait till the end. File your return on time before 31st of December to avoid last minute hassle. Also, if you have traded in stocks and have incurred capital gains or losses, then the return filing gets a bit more complicated. But we are here for you, always here to help. You can claim Clear's expert assisted e-filing services. Our experts will offer these services via video call, and you will also get best tax saving strategies, and we will also take care of your return filing from start to the end. You can get a 20% off on our assisted services. All you have to do is use the coupon code OFF20. To avail these services, go and check the link in the description box below. Do like, share and subscribe to our channel for more such informative videos, and do not forget to claim the free gift by subscribing to our channel. Stay tuned, take care and goodbye.